The global banking system just revealed a crack, and it is spreading through the silver market faster than most people realize. What started as whispers in trading rooms has become a structural crisis that threatens to redefine how precious metals are priced, traded, and delivered. The institutions that have controlled this market for decades are facing a reality they never prepared for: the difference between owning a contract and owning the metal. If you've been watching silver climb, or if you've stayed on the sidelines waiting for clarity, the next several minutes might reshape how you think about what is unfolding right now. This isn't theater. This is mechanics. This isn't hype designed to move you emotionally. This is a breakdown of incentives, bottlenecks, and mathematical realities that are forcing the market to confront decades of assumptions. I am going to take you inside the numbers, the incentives, and the structural breakdowns, so you can trace the logic for yourself and decide what it means for your position. You won't need to trust me. You'll be able to verify every claim against publicly available data. And more importantly, you'll understand why this moment is different from the rallies that came before. Because what we're witnessing isn't just another rally. It is what happens when confidence in paper collides with demand for the physical asset. It is what happens when the architecture built to facilitate trading becomes the very thing preventing delivery. It is what happens when decades of derivative expansion meet a finite physical base, and the physical base refuses to expand. So let me start with a question that cuts to the core of everything we're about to discuss. What occurs when the claims on an asset outnumber the asset itself, and everyone realizes it at the same time? What happens when the crowd that was content holding promises suddenly demands the real thing? What happens when the system that was built to absorb that demand discovers it cannot? The answer is unfolding in real time. Today is Tuesday, the 10th of February 2026, and silver is trading in the low to mid $80 zone per ounce. That figure alone is forcing institutions to abandon assumptions they've relied on for years. Trading desks that built models around normal silver behavior are discovering those models don't function anymore. Risk management frameworks that assumed certain price ceilings are being rewritten in real time. The algorithms that were programmed to fade rallies are getting stopped out repeatedly. Analysts had positioned for pullbacks that never materialized. Forecasts that called for mean reversion to lower ranges have been abandoned instead. The hunger for actual metal slammed into a derivatives market overloaded with exposure, and the impact is reverberating across continents. What was supposed to be a manageable correction turned into a sustained advance that has left short sellers scrambling and institutional desks reassessing everything they thought they knew about this market. The velocity of the move matters as much as the magnitude. When markets move slowly, participants can adjust, they can hedge, they can reposition, they can manage risk incrementally. But when a market gaps higher day after day, and when each pullback is shallower than the last, when resistance levels are breached without hesitation, that is when psychology shifts from skepticism to panic. That is when the question changes from "should I buy" to "can I still get in?" And for those on the wrong side of the trade, the question becomes even more urgent. How do I get out? Have you seen how fast certainty vanishes when substitutes stop being acceptable? Have you watched a market where the crowd that was comfortable holding paper suddenly demands physical delivery? That transition doesn't happen gradually. It happens in waves, in surges, in moments of collective realization that ripple through the system faster than anyone can contain. Now layer in context that makes this moment even more peculiar. The Chicago Mercantile Exchange just launched a 100-ounce silver futures contract, exactly as physical availability began tightening. The timing alone raises questions that deserve examination. The official narrative frames it as democratization, smaller size, lower barrier, broader access. It is marketed as a tool that allows retail traders to participate in a market that was previously dominated by institutional players moving 5,000-ounce contracts. But when a new exit appears during a rush, the question becomes, who does that exit actually serve? Is this genuinely about retail access? Or is it about providing a relief valve for participants who need to unwind positions without triggering a cascade? Is it about democratization? Or is it about damage control? Markets rarely introduce new instruments during calm periods. New products tend to appear when existing structures are under stress. Consider the mechanics. A 5,000-ounce contract at $80 represents $400,000 of notional exposure. That is institutional scale. 100-ounce contract represents $8,000, accessible to a far broader pool of participants. On the surface, that seems beneficial. More participants, more liquidity, deeper markets. But liquidity is a double-edged instrument. It can facilitate efficient price discovery, or it can facilitate efficient unwinding of losing positions. Because this rollout coincides with what market participants are labeling the most intense physical supply stress in modern memory. And the stress isn't theoretical. It is visible in vault counts that are declining when they should be stable. It is visible in borrowing costs that are spiking when they should be contained. It is visible in delivery strain that is intensifying when it should be resolving. It is visible in premiums that refuse to normalize, despite prices that have already moved substantially higher. The juxtaposition creates a narrative tension that is difficult to ignore. Either the timing is coincidental or the timing is strategic. Either the exchange saw an opportunity to serve retail demand, or the exchange saw a necessity to provide large participants with an alternative settlement pathway. The truth might lie somewhere between those extremes, but the questions themselves reveal how fragile the current equilibrium has become. Let me translate the infrastructure in a way that makes the vulnerability clear. In the futures ecosystem, most contracts settle without physical transfer. That is not a flaw, it is a feature. It is designed that way. Futures markets exist to facilitate hedging and price discovery, not necessarily to move metal from sellers to buyers. The vast majority of participants are speculators, hedgers, or market makers who have no intention of taking or making delivery. Positions get rolled forward to the next contract month, closed out before expiration, or netted in cash settlement. That is how the system operates under normal conditions. But the entire architecture rests on a single assumption that is rarely tested. If delivery is demanded in sufficient volume, deliverable metal is available. That assumption is the foundation of price legitimacy. If the futures price and the physical price diverge too far, arbitrage should close the gap. Someone should buy the cheaper one, sell the expensive one, and pocket the difference. But arbitrage only works when the underlying asset is actually available for delivery. When it is not, the mechanism breaks down. The paper price becomes detached from the physical price, and when that detachment becomes visible, confidence begins to erode. That erosion is what we're beginning to witness. The futures market is supposed to reflect the physical market, but increasingly, it appears the physical market is pulling away from the futures market. Premiums are expanding, delivery delays are extending, availability is tightening, and the gap between what the screen says and what you can actually acquire is widening. That is where current data becomes troubling and where the mathematics start to look genuinely problematic. The relationship between open interest and registered inventory has been reported near 416%, meaning the total claims vastly exceed the metal designated for delivery. To put that in perspective, for every ounce of silver that is committed to satisfy delivery requests, there are more than 4 ounces worth of contracts that could theoretically demand delivery. Now, under normal circumstances, that ratio isn't catastrophic. Most contract holders never stand for delivery. They close their positions, they roll them forward, they settle in cash. The system is designed around that behavior, but normal circumstances assume that participants are confident the metal would be there if they asked for it. Confidence changes behavior, and when confidence shifts, behavior that was predictable becomes unpredictable. Registered inventory represents bars committed to leave the warehouse. These are ounces that have been earmarked, allocated, and made available for delivery against maturing contracts. Eligible inventory is metal stored within the system, but not allocated for delivery. It is owned by someone, a bank, a fund, an industrial user, and it is sitting in an approved vault, but it is not available for contract settlement, unless the owner chooses to convert it to registered status. They are fundamentally different categories, and conflating them is a dangerous analytical error. Market estimates suggest the immediately available supply is dwarfed by the paper contracts referencing it. Some analysts have pointed to registered inventory levels that, if converted to contract equivalents, would satisfy only a fraction of open interest. Others have highlighted the rate at which registered inventory has been drawn down in recent months, suggesting that delivery requests are accelerating, not moderating. So the question becomes, when holders begin standing for delivery, who receives bars and who receives explanations? Who gets metal, and who gets offered cash settlement at a fair price, determined by the very exchange that cannot deliver? Who gets what they contracted for? And who gets told that physical delivery is impractical given current market conditions? These aren't hypothetical questions. These are the questions that will determine whether this market resolves through price adjustment or through structural failure. Meanwhile, the geographic price differential is impossible to ignore, and it is creating a drainage mechanism that is pulling metal out of Western vaults at an accelerating pace. Asian markets have been quoting silver at premiums approaching $6.50 relative to New York levels, creating a powerful arbitrage mechanism that functions like economic gravity. When you can acquire metal in one location and sell it higher elsewhere, conspiracy theories aren't needed. Economic gravity does the work. Traders don't need to coordinate. They don't need to collude. They simply need to recognize the spread and act on it. That premium functions as a magnet pulling inventory eastward. It is not subtle. It is not hidden. It is openly quoted, openly traded, and openly exploited by anyone with the infrastructure to move metal across borders. The mechanics are straightforward. Buy in New York or London, where prices are lower. Ship to Shanghai or Hong Kong, where prices are higher. Pocket the difference, minus transportation and insurance costs. When that spread is $6 on an $80 asset, the profit margin is substantial enough to justify significant logistical effort. But here is what makes the current dynamic particularly consequential. The flow isn't balanced. It is not a two-way market where metal moves east when premiums are high and west when they are low. The flow has become structurally unidirectional because of regulatory and policy factors that didn't exist in previous cycles. Add another detail that reshapes flow dynamics and creates a ratchet effect. Regulatory barriers making metal imported into China unlikely to re-export. Once silver enters Chinese territory, various restrictions, some explicit, some administrative, some simply practical, make it difficult for that metal to return to Western markets. That converts bilateral trade into unidirectional movement, and unidirectional movement drains the origin point. It is not a temporary imbalance that self-corrects. It is a structural feature that compounds over time. What emerges is what traders call a structural deficit consumption, outpacing fresh supply year over year. Not a cyclical shortage that resolves when prices adjust, but a persistent gap that reflects fundamental mismatches between where silver is produced, where it is consumed, and how easily it can move between regions. The global silver market is becoming fragmented in ways that prevent efficient rebalancing, and fragmentation in commodity markets tends to amplify price volatility rather than dampen it. 4 consecutive years of deficit produces a straightforward outcome: existing stockpiles shrink. This isn't speculation, this is arithmetic. When you consume more than you produce, the difference comes from inventory, and when that pattern repeats year after year, inventory levels decline year after year. The question isn't whether this is happening, the data confirms it is. The question is how much longer it can continue before the system reaches a breaking point. Estimates place the annual shortfall around 200 million ounces. That is not a temporary mismatch. That is a sustained imbalance that represents a significant percentage of total annual supply. To put it in context, global silver mine production is roughly 800 million to 850 million ounces per year. A 200 million ounce deficit means the market is consuming roughly 125% of new supply annually. The extra 25% is coming from above, ground stockpiles, and those stockpiles are finite. When an imbalance repeats, it transitions from anomaly to baseline. It becomes the new normal. Markets can defy fundamentals for extended periods until physics reasserts itself. Prices can remain disconnected from supply, demand realities while inventory exists to buffer the gap. But when inventory depletes to critical levels, the buffer disappears. And when the buffer disappears, price becomes the only mechanism available to ration supply. The market has been living on borrowed time, borrowed from accumulated stockpiles built during previous surplus periods. But those surpluses ended years ago. The inventory is being drawn down, and the rate of drawdown is accelerating as industrial demand intensifies and investment demand awakens to the tightness. Now consider, if inventories are being depleted to satisfy current demand, what happens when additional demand enters the system? What happens when industrial users who have been operating just-in-time inventory systems suddenly decide they need to hold buffer stock? What happens when investors who have been watching from the sidelines decide the risk of missing the move outweighs the risk of entering at current levels? What happens when the marginal buyer becomes less price-sensitive because the alternative, not having metal, becomes unacceptable? That additional demand is already present, and it isn't speculative froth driven by momentum chasers hoping to flip positions for quick profits. Industrial usage represents approximately 56% of total demand, and industrial demand destroys metal in a way that investment demand does not. This is a critical distinction that many market observers fail to appreciate fully. Gold is hoarded, it sits in vaults, it gets passed from owner to owner, but it remains available to the market. Gold doesn't disappear, silver is consumed. Once silver is embedded in products, retrieval is frequently uneconomical. It is dispersed in quantities too small to justify recovery, or it is bonded in ways that make extraction impractical, or it is simply cheaper to use newly mined silver than to recycle old silver. Photovoltaic cells, electronics, medical devices, relays, conductive pathways, these aren't collectibles that might someday return to the market. These are consumptive channels that remove silver from the available pool permanently. Each solar panel installed represents silver that won't come back. Each electronic device manufactured represents silver that won't be recovered. The consumptive nature of industrial demand creates a one-way flow out of the available supply pool, and that flow has been accelerating. The artificial intelligence infrastructure wave has intensified the draw in ways that were not fully anticipated, even 2 years ago. Advanced computing isn't purely software running in abstract cloud environments. It requires physical hardware, interconnects, thermal regulation systems, specialized components. Data center expansion demands massive quantities of conductive and dependable materials, and silver's combination of electrical conductivity, thermal conductivity, and reliability makes it irreplaceable in many applications. You can substitute other materials for silver in some uses, but often at the cost of performance, reliability, or both. Layer in electrification, automotive transition to electric vehicles, grid infrastructure upgrades, charging network deployment, and you create a demand profile that doesn't pause for price moderation. These are multi-year capital projects with committed timelines and locked-in specifications. When an automotive manufacturer is ramping production of electric vehicles, they can't suddenly redesign their electrical systems because silver got expensive. They're committed, they need the metal, and they'll pay what they need to pay to keep production moving. So here is the challenge that monetary policy cannot address. Can monetary tightening halt a manufacturer with committed delivery schedules and contractual obligations? Can interest rate increases stop a solar installation project that has already been financed, permitted, and begun? Can central bank rhetoric reverse infrastructure spending that has been legislated and funded? The answer is no. Industrial demand has momentum that operates independently of financial market sentiment. Recycling can't bridge the gap. silver is deployed in minuscule amounts across billions of units, which makes recovery costly, inefficient, and time-intensive. And mining doesn't operate like a valve. Most silver production arrives as a byproduct, approximately 70% from copper, lead, and zinc extraction. That means silver supply doesn't respond directly to silver pricing. It responds to the profitability of other commodities. Even when producers attempt expansion, lead times are punishing. From discovery to commercial output can span 7 to 12 years. Permitting processes, capital acquisition, infrastructure development, none move at chart velocity. Meanwhile, major sourcing regions, Mexico, Peru, China, Poland, Australia, face individual constraints. Mexico frequently accounts for roughly 1/4 of global output. Peru's operational disruptions and political volatility have introduced uncertainty. And ore quality. Industry observers note declining grades over decades, requiring increased processing volume for equivalent output. Costs escalate when geology becomes less generous. Primary silver producers' all-in sustaining costs are commonly discussed in the mid-teen dollar range per ounce, establishing a long-term price floor. But today's issue isn't profitability. The issue is that supply cannot accelerate on demand. When supply moves slowly while demand accelerates, price becomes the communication mechanism. Price is how markets speak when language breaks down. Now examine the arena where pressure manifests first. Exchanges have authority to increase margin requirements. Recent adjustments, around 18%, have been implemented to dampen speculative excess. Elevated margin demands more capital to maintain positions. In theory, that should cool enthusiasm, but it carries a secondary consequence. It can annihilate participants caught with outsized short exposure when price ascends. Shorts don't merely lose value, they must fund the position. Large financial institutions have maintained long-standing operations in precious metals custody, leasing facilitation, and derivative structuring. The London over-the-counter framework also commands significant influence over global liquidity. A critical indicator, London silver lease rates have been quoted above 6%, signaling physical scarcity. When borrowing metal becomes expensive, it typically indicates metal is difficult to locate. That is the core narrative. The screen price can display one reality while the physical marketplace reveals another. When industrial buyers genuinely require silver, they don't accept promises, they demand bars. Reports indicate some have approached refiners directly, circumventing conventional distribution channels. That eliminates the buffer institutions traditionally used to manage supply and coordinate deliveries. What unfolds when the intermediary loses control of the gateway? Refiners and mints have reported unprecedented demand strain. When mints institute allocation protocols, it is a transparent signal they cannot fulfill orders at a standard pace. Retail premiums above spot have expanded, with certain products exhibiting premiums exceeding 30%, which translates to the advertised price is not the transaction price. The gap between quotation and acquisition is a diagnosis. This brings us to the fundamental distinction between paper and physical. Paper silver, futures, ETFs, unallocated accounts, represents a claim on silver. Physical silver represents possession of silver. In stable conditions, that distinction feels academic. In stress conditions, that distinction becomes existential, because claims can be created infinitely. Metal cannot exchange. Traded products marketed as silver exposure vary dramatically in structure. Some hold allocated bars with serial numbers and audit trails. Others hold unallocated positions, where you own a share of a pool, not specific metal. Still others use futures contracts or swaps, introducing counterparty and rollover dependencies. Vault location, redemption terms, and custodian identity matter intensely when stress emerges. If you can't touch it, audit it, or withdraw it, do you actually own it? Now let's address sovereign and institutional positioning. Central banks globally hold predominantly gold, not silver, but large financial entities operate substantial silver books, both long and short. Short positions can originate from hedging mining output, facilitating industrial purchases or speculative positioning. In a rising market, large shorts face mounting losses and financing pressure. And when shorts are held by institutions considered too important to destabilize, systemic concern enters the equation. This isn't conspiracy. It is risk management at the systemic level. Regulators monitor concentrated exposures because cascading failures can propagate through interconnected balance sheets. Silver might seem niche, but if a major participant faces catastrophic loss in one market, contagion can spread to others through credit lines, collateral chains, and confidence erosion. That is why markets sometimes behave as if invisible hands are guiding outcomes. Let's examine delivery mechanics. Futures contracts approach expiration in monthly cycles. The March contract is approaching, followed by May, July, and so forth. Each expiration creates a decision point. Roll the position forward, close it, or stand for delivery. Most participants roll or close, but a subset demands physical settlement. First notice day and first position day are procedural milestones that compel position declarations and rolling choices. Volatility frequently intensifies around these dates. If an unusually large cohort of longs demands delivery, the exchange must source additional supply or incentivize eligible holders to convert inventory to registered status. But eligible holders aren't contractually obligated to release metal. Many are storing for proprietary purposes, so the dynamic becomes you cannot compel a reluctant seller without altering the price. Administrative mechanisms exist, fees, rules, incentives, but none manufacture ounces. This is where decades of derivative proliferation encounters a relatively inelastic physical foundation. When confidence wavers, the scramble intensifies because no participant wants to be positioned last when supply exhausts. And that feedback mechanism can self-amplify. Supply constraint elevates price, which intensifies urgency, which further constrains supply. There was a recent narrative disruption, a development that briefly convinced markets that aggressive monetary policy might crush commodities. A prominent Federal Reserve nomination triggered hawkish interpretation, and precious metals retreated. Silver pulled back toward the low 70s, offering shorts temporary relief. But the relief proved ephemeral, because even the most stringent central banker cannot produce physical silver. Monetary policy can influence financial positioning, but it cannot reverse industrial consumption overnight. Solar deployment continues, driven by economics, regulation, and energy requirements. Electric vehicle infrastructure advances, because supply chains and capital commitments are already in motion. Artificial intelligence computing capacity expands, because competitive pressure mandates it. The market recognizes the limitation. Policy can moderate sentiment, not generate supply. And that recognition propelled prices back into the 80s, ensnaring anyone who interpreted the pullback as a permanent reversal. Return to that 100-ounce contract. Advocates argue it broadens participation. It is substantially smaller than the standard 5,000-ounce contract, and at prevailing levels represents thousands, not hundreds of thousands of dollars in exposure. Skeptics argue the timing serves large shorts seeking a controlled exit mechanism. When a vessel lists, the crew searches for lifeboats, and markets search for mechanisms. There's also the settlement structure question. If a smaller contract employs pooled certificates, rather than direct warehouse receipt delivery, retail participants must comprehend what delivery actually means within that framework. Details that appear trivial during calm periods become definitional during turbulence. So the question, do you understand what you possess, or merely what you assume you possess? History provides another reference, the Hunt brothers episode of 1979 through 1980. They accumulated massive exposure. Silver surged and the exchange modified regulations, restricting new long positions and forcing liquidation. The aftermath was devastating, but today's dynamic differs fundamentally. Current pressure stems from industrial demand and chronic deficit, not concentrated speculative accumulation. You can liquidate speculation, you cannot liquidate consumption, and silver's marketplace is now globally distributed in ways it wasn't historically. Price discovery isn't confined to a single venue. Asian markets exert greater influence. India's cultural and seasonal patterns add complexity. Middle Eastern centers like Dubai have expanded. A more dispersed market resists control via singular regulatory levers. The center of influence has shifted, and legacy assumptions are destabilizing. Demand is also diversified. Jewelry and tableware remain significant. Investment products, bars and coins, matter substantially. Photography has contracted, but hasn't disappeared. Electronics, beyond artificial intelligence and solar switches, contacts and specialized components, consume consistent volumes. Medical applications, antimicrobial treatments, water purification, brazing compounds, each contributes a stream. This diversity renders demand resilient. No single sector can collapse and resolve the deficit immediately. When demand has multiple foundations, it doesn't collapse easily. Governments have taken notice. Energy transition strategies have elevated critical mineral inventories into policy frameworks. Supply security becomes strategic. When a material is essential for infrastructure, defense, and advanced manufacturing, its availability is a priority. The United States previously maintained silver stockpiles and subsequently liquidated substantial portions. Currently, renewed supply chain anxiety has revived conversations about strategic reserves and domestic production support. But policy, again, doesn't generate rapid ounces. Domestic production confronts permitting obstacles and extended timelines. Regions with known deposits still require capital and regulatory approval. Latin America's political transformations, nationalization risks, and regulatory instability can deter investment. All reinforce the identical conclusion. The deficit doesn't evaporate because policymakers desire it. And when deficits persist, they eventually manifest through price. Now let's make this tangible and actionable. The argument for silver isn't a profit guarantee. It is a framework for understanding why a market can appear irrational indefinitely and then abruptly transition into a new equilibrium. Silver's dual nature as both industrial input and historically monetary asset makes it responsive to manufacturing demand and currency system confidence simultaneously. That duality can create moments where diverse participants pursue the same objective concurrently. Historically, fiat currencies tend to erode purchasing power across extended periods. The pattern persists when confidence in paper deteriorates. People seek the tangible trust fractures gradually, then fractures completely. So what does $82 signify? Not merely a quotation. It signifies decades of supply underinvestment, expanding industrial application, supply response lag, and a trading architecture that grew comfortable issuing claims. The institutions that historically influenced this market through scale and structure are discovering that paperwork cannot satisfy physical shortage. The market is being compelled to reconcile narrative with inventory. The upcoming inflection points are concrete: March delivery cycle, followed by subsequent cycles in May and July, each representing another stress juncture where physical reality can reassert dominance. Monitor lease rates, monitor premiums, monitor how rapidly price declines are absorbed, and critically monitor whether the public quotation and the physical transaction price continue diverging, because that divergence is the signal conventional analysis frequently overlooks. If you extract the deeper principle, it is this. Silver is demonstrating a timeless financial pattern in real time. When systems depend on confidence and confidence encounters constraint, the constraint prevails. And whether you participate in silver or not, comprehending that dynamic sharpens your analysis of every market. Before closing, the necessary caveat: this is educational content, not individualized financial guidance. Your circumstances, risk capacity, and investment horizon are more consequential than any chart pattern. If you choose to participate, understand the instruments, understand custody, and understand liquidity constraints. And if you observe from the sidelines, internalize the lesson. Physical supply chains can overpower narratives. If this analysis clarified your thinking, please subscribe so you are positioned for the next development in this unfolding situation.